Individual investors are often criticized for their bad investment behavior. They buy high, sell low, flock to trendy investments, and get scared out of sticking to their plans when the markets shift, whether because of news from Twitter or a lack of news from Washington, D.C. Indeed, behavioral economists have been producing reams of research to explain how our brains are almost hardwired for investment errors. But individual investors aren't the only ones who abandon rational thought in the face of market jitters. Institutional investors also make wealth-destroying errors. Institutional Investor magazine talked to the top endowments, foundations, and public and corporate pension plans about the mistakes investors make and how even the most knowledgeable professionals can make lousy decisions that cut deeply into returns. So what mistakes do money managers make most often in trying to generate alpha?
Well, there's several, and they come back to some core themes. And I'd say the first core theme is not having that hard look in the mirror, not understanding where they really are and where they are competitively. And that goes to two things: the illusion of control, thinking that you're smarter, you're going to know when to get in and when to get out, and the other guy won't. That is essentially just flawed thinking. And the other issue would be one related to leverage, or several issues related to leverage. First, leverage is not something that just makes good things better and bad things worse. Leverage is something that can make good things better and bad things fatal. Fatal. If you are levered and you make a bad decision, the game is over. It's not a question of if I'm levered and things go well, I win by more, but I might lose by more if I lose. No, you may never play another game.
On my list of the kind of two biggest flaws that I see other investors get mired in is time horizons that are too short. And the second is this kind of insatiable desire to have identifiable catalyst in advance of investing. So you will hear in conversation, what is the catalyst? What is the catalyst? What is the catalyst that kind of opens up the alpha generating opportunity? And in many instances, if value is present, just because an identifiable catalyst can't be articulated doesn't mean that it's not a good investment.
When portfolio managers attempt to generate alpha and start chasing a recent trend or getting too crowded in their head with the recent noise or the newspaper stories or the GDP effects on a particular sector or company, that's when they lose their way. You have to keep a portfolio manager focused on buying a company for the right reasons, for the growth reasons, for the strategic reasons, and for the governance reasons, governance being one of the most important factors in long-term alpha, and then not getting swayed by short-term movements in the market. Because when it goes to the end investor wants long-term compounded annual growth rates. And so the mistake that the end investor makes in a search for alpha is they too can get swayed by the noise of recent events and perhaps take money out at the wrong time or put money in and chase things at the wrong time.
There are two factors that will define the success or failure of managers that I have found in my career. One is culture, and part of that is the business practices of the firm. Are they asset gatherers? Are they really disciplined about their investment process? What is the philosophy of the person at the top? And how important is the business management aspect of the firm, let alone just the investment process? Right. The second is sell discipline. Many investors buy right, but they either fall in love with their investments or they leave the party way too late. So if you can find managers that get those two things correctly, chances are you're going to earn alpha. The biggest mistake I think institutional investors, and by that I mean endowments and foundations, family offices, pension funds make, is that they conduct the due diligence on the product, not on the firm. I'm concerned about investment products that are offered by big investment banks. Typically, you've got a very disparate culture between an investment management activity and an investment banking activity. Which part of the culture prevails, and how will that affect the execution of the product? To simply look at the product and not take into consideration the firm is a huge mistake, and one that is frequently made.
The number one biggest mistake by far that institutional investors make, and I'll speak for the corporate world specifically, is they get the governance structure wrong. The typical governance structure keeps too much of the decision-making authority with an investment committee. That investment committee is typically made up of non-investment professionals. These are your finance heads, your legal heads, your HR heads, and such. This is not what they do for a living. That's the wrong place to be making those decisions. The second one, I would say, is about being functional, creating a functional work environment. And that's a little bit more difficult. I think the first one is easy. The second one is more difficult. It's skill and luck, building a team that gets along, that has good, competent people that know what they are expected to do, are given the authority to do that, and then feel good about the work that they're doing. Getting down to the investment team that maybe is often a mistake is that too many times the decisions are influenced by biases or simply a fear to make decisions. And maybe the fear comes out of the governance structure. But if you're not going to be different from your peers, then I don't know how you're going to succeed consistently over a long period of time.